p.m. in London. Good evening, wherever you are, and welcome to the GAIN session on a career in investment management and what a career in investment management looks like. We are really delighted to be here with you today. We know it's been a challenging time for students, and let me assure you it's been a challenging time for all professionals and probably safe to say everyone we know. So it's important that you set aside the time to think about your future, talk to practitioners like us, and have some ideas about career development and what are the right questions to ask as you consider a path in investment management. So the four of us here, Emma Gallagher, Emma Cohen, Anna Maria Harrison, and myself, will introduce ourselves first and tell you a bit about our background and how we became investment professionals, what have been the highlights and the lowlights of that process, what have we learned, and what we'd like you to think about as you make some initial career choices. So we'll probably take about 20 minutes to do that, and then we'll open up to questions. We have some questions prepared to ask if no one steps up to the task. So we actively encourage you to use the chat function or raise your hand, and we'll have an engaging discussion with you, and then create some opportunities to follow up if that's necessary. So with that, I will tell you a little bit about myself. As you can tell from my accent, I'm not from here. I am, in fact, of Russian origin. My family immigrated to America when I was an adolescent. So my American accent comes from the fact that I have been to high school and university in the US. And I moved to London in 1997 when I met my now husband, then great fun French boyfriend. And that's how I have a funny surname as well. So I've been in London since 97. I joined Capital Group in 1996, coming straight out of business school. Before business school, I was involved in investment banking, and I can tell you why if we go into Q&A. But I decided to change from investment banking into investment management whilst I was at Harvard Business School, and that was the best choice I ever made. Within Capital Group, my responsibilities were initially focused on analyzing companies that were going through a major transition in Russia and Eastern Europe from being state-owned to becoming listed. And changing that ownership meant that the companies would change their governance, they would change their asset allocation. And I felt it was a very exciting time to be an investor and thinking about these long-term choices. I was an analyst for a number of years. I became a portfolio manager sometime later. And in that time, I also realized that I wanted to spend more time thinking about and analyzing non-financial information about companies, which we now refer to ESG. But they're really things that mattered in the long term to the success or failure of an investment that were not captured in just the financial statements. And they included how they treat their community, how they treat their environmental responsibilities, and how decisions are made in the long term. So I've decided actually last year to take a little career break. I'm actually now a retired partner from Capital. And I was saying earlier to the other panelists that I feel pretty clever having chosen this year to be the year that I don't travel and spend more time at home, given that that's what everyone else is stuck doing too. But I really want to spend more time with my kids, who are now actually also college student and a sort of soon to be college student. So in that quick overview, a couple of things I want to leave you with is one, I was not a math wizard and I was not a STEM focused student in my studies at Georgetown. In fact, Emma and I also share one thing together. We went to Georgetown University in the School of Foreign Service. I studied international economics and I didn't know balance sheet from my elbow. And so I had to do a lot of that learning on the ground once I chose to go into investment banking. But what really made me decide to go into finance was not because I was a natural math wizard. It was my curiosity about the world and what makes markets sort of thrive under different kinds of conditions. Second thing I want to say to you is that it's a great time to be a woman going into investment management. In fact, I think there's never been a better time because we have a lot of opportunities to do very different things that women are good at, like asking questions, like working collaboratively and helping each other succeed, and also helping teams succeed. And thirdly, working for building relationships for a long time with managements and boards that is not focusing just on short-term sort of quarterly results, but really long-term themes, which I think women do very, very well. So I'll leave you with that, and I will move the mic over to Anna, the virtual mic.
Great, thank you so much for that, Natasha. Very interesting to hear. So I started my career in investment in 2005, and that started as an internship with a company called Baillie Gifford, and they were based up in Scotland, which so it not only involved trying a whole new job, it obviously involved trying a whole new city as well. And the internship was an 8-week long program, and it really kind of gave you a true feel for what the job is like on a day-to-day basis. You were basically doing the job of an analyst and an investment manager every day as part of that internship. And for me, that was a really, really positive experience. And I found that the job in investment really suited my skill set. So the things that I was really interested in was research, was sort of understanding a lot of new material, understanding how the world was changing, and also learning a lot about China, which is something I'll come back to later. This was something I was really, really passionate about. When it came to the end of that internship, I was lucky enough to be offered a job. And so I started in 2007 working at Baillie Gifford and doing their graduate training program. And that involved a rotation program across different geographical teams. So I started on the US team and then moved on to emerging markets and then moved on to Japan and then moved on to global. So that was a 4-year period. And, similar to what Natasha said about kind of, not being a STEM student, my undergraduate degree was in English literature. And so, this was a fantastic opportunity for me really to learn how to analyze a business from a financial perspective and learn about accounting and valuation, and really proved it, an invaluable experience. At that point, I sort of felt like I wanted to concentrate more on China and more broadly on Asia. So just to touch on as well, either side of my degree, I spent 2 years living and working in China. So 1 year before university and 1 year after university. And my role at Baillie Gifford was fantastic. It's an amazing company, but it was a very, very broad role. And I kind of wanted to concentrate a bit more on Asia. It was also a very large company. There was about 100 people in the investment team, so a combination of analysts and investment managers. And I really wanted to work somewhere smaller and feel a lot more connected to the outcome. And through maybe a bit of chance and maybe a bit of hard work, who knows, I was introduced to a company in London called Prusik. Now, Prusik is an Asian specialist, and it's also a much smaller company. So there's only about 15 to 20 of us in the company overall. And this has enabled me to kind of focus on what I really am passionate about, which is Asia, and also have a lot of responsibility in terms of decision making, which is something that really excites me. So I've been at Prusik now for nearly 10 years. And in the last 2 years, I've started to manage my own fund, which is the Prusik Asia Emerging Opportunities Fund. And for me, this is kind of a dream job. I get to sort of choose how I work and also what I focus on. I get to lead in terms of decision making, and I get to see the output of those decisions. And I just find it very gratifying in many different ways. But yeah, I'll leave it there. But yeah, hopefully that gives you some introduction.
That's great. Thank you, Anna. And then we move to Anna Maria next.
Great. Hi, everyone. Nice to meet you. I'm a partner at a private equity fund based in London called Adam Street. I work mainly with our investors in Europe. Spent about 23 years working in finance. How I ended up in finance was not planned at all. I am from Venezuela, and I went to university in the US. My English was not great. So when I was choosing what to study, I was good in math. So I chose something related to math. And I studied economics and international relations. After finishing my university at Northwestern University in Chicago, I went to New York for 5 years. And My first job was actually in sports management. I loved sports. I used to be an athlete, and I soon realized that sports is great when you play it, but I wasn't so excited about the management part of it. And I had a friend that was working at an investment bank, and they needed somebody that spoke Spanish. So the reason why I came into finance was because of my language skills. I speak a bit of Italian, Portuguese as well, but Spanish helped. Spent 4 years or so in New York working in finance, and then decided to take a break and do an MBA in France. Reason why I did that, my brother did one and a lot of people around me were doing one, and I thought it would be fantastic to spend a year in a fun place. And I went to INSEAD for 1 year, where I met my husband. We came to London for a 2-year stint, and it's now 20 years after we're still in London. When I finished my MBA, I continued in finance, and I found something that was just was just very exciting about finance, which is private equity. I always liked finance, but it was more of the people management side, the being with investor side. And when I looked at the growth of private equity and I understood what it means to buy a company, make it better, and sell it, something clicked in that. I really just loved the industry, and I felt like I really understood what we were trying to do. So I've been in private equity for about 20 years now, and I started on the investment side, and then I had children and didn't want to travel as much, and I love being with investors, and I moved then to the investor relations side, where now I help very large institutions build portfolios and invest into the asset class globally. So that's me.
That's great. Thank you very much. Emma.
Hi, everybody. So I'm Emma. I currently work for Goldman Sachs Asset Management in their fixed income business. I've worked in London in the fixed income business for 5 years now. I'm a trader. I'll come back to that in a little bit. And before that, I spent 2 summers interning in New York, so kind of been with them since 2013. So I think I would just start by saying, if you'd met me when I was in high school or even the beginning of uni, like, I would never have expected to be where I am today. My mom owned an independent video store in Los Angeles. My dad's an architect. Finance was so far from my radar, I can't even describe. As Natasha said, I went to Georgetown, thought I wanted to be in politics. I was in the School of Foreign Service, studying international affairs, science, and technology, and really trying to figure out what my interests were and my passions. I think I wasn't closed to any opportunities, but it definitely was not something I was kind of gearing towards at that point in my life. And then I actually just kind of fell into the concept of finance as an internship because I made some really good friends at Georgetown who were studying in the business school and mentioned to me these summer programs. And for a lot of people, that's actually how they get introduced. And hopefully many of you will have the opportunity to join an internship program at either an investment manager or a bank more generally, because it's a really good way to test a theory about if you like something. And I would say, when I was thinking about that process of where I wanted to start my career, I thought about, what do I like? And for me, I was just interested in learning. I constantly wanted to find a new topic, dig deep into something and follow stories that were happening in the world. So for me, that meant picking up the Wall Street Journal or the FT here and really getting into the macro events that were happening in the world, what companies were buying other companies. These are things that I was getting interested in. And I thought, actually, this might lend itself to finance. I was not a math wizard. I've not taken a proper math class since I was 18. Don't tell my bosses. But, I do think I was really drawn to the stories, the macro. So I applied to the internship. I got a serious crash course in interviewing, so happy to talk about that later as well. I had 27 interviews at Goldman over a 2-day period when I was 21, and they crossed across Jersey and New York. So it was very much like a rat race. And it actually was great because it let me learn a lot about the industry. I didn't know where I wanted to end up, and then I ended up in investment management. And I think I chose investment management because I like the concept of having a worldview and building portfolios around that. And I think that's what's so exciting about being an investment manager, is that not only do you get to, pick up on topics, but you get to see how those topics can lead to performance for clients, and how those kind of your worldview can end up informing decision making in your environment. So just quickly on what I do at Goldman. So I started in the first year in what we would call like a graduate role, product management and fixed income. So what that meant in practice was I was aligned to a portfolio manager and a strategy, and we worked on analysis for clients, pitching new business, coming up with product opportunities, very much like a commercial role and very much a graduate role, in that you're learning constantly about different topics. After a year, I moved into a trading seat on our flagship money market funds. So money market funds, the simplest way to explain them would be, it's essentially another instrument for large corporates with money to put when they want to be able to withdraw their money instantly, but don't want to put it at a bank. And the reason they would go to a money market fund instead of a bank is that we invest in diversified products, so they don't have risk to just one institution. And then 2 years ago, I moved into my current role, which is investment grade corporate credit trading. So what we do is we look at companies and we choose bonds for portfolios, and we invest in the investment grade space. So, think about large corporates like Apple, Google, Starbucks, and basically a lot of companies you think of as household names. They issue bonds, and we decide whether or not to buy those bonds for client portfolios. So that's kind of the round trip. And I would say I still don't know where I might end up, but I think what I found in investment management is there's so many opportunities, and getting your foot in the door and figuring it out as you go along is actually a really good strategy. Because I think if you ask a lot of people, who seem to have had amazing careers, like the people on these calls, they might not have known exactly where they were going to end up, but probably followed these tangents of interest along the way.
Thank you so much, Emma. That's a great point, because the fluidity itself, which is characteristic of financial markets, creates opportunities. And some asset classes that are really important today were either minor or didn't exist 20 years ago. And I wonder if it could be useful to just level set the knowledge base of all the participants to just review a little bit the value chain of investment management. So let's maybe just take 2 minutes to do that, and each of the panelists can add sort of a personal dimension to that. So the way it was explained to me, and I thought was always most practical, is to say this: there are sources of investment capital. They can be pension funds, endowments, individuals, but they are what we call in the industry asset owners, people who want to deploy their savings for investment purposes. And essentially, the rest of the industry is providing a service to the asset owners. So investment managers essentially are managing money of individuals, families, or pensions and endowments on their behalf. Private equity companies do the same with a different objective. The asset owners need to decide how to allocate their capital between fixed income, which is Emma's specialty, private equity, what Anna Maria does, general equity and fixed income portfolios, which is what Capital Group does, or if they want to have some very specific exposure, like Anna's Prusik Asia Fund, to do that. So there are a lot of decisions that are made in the industry as to where investments are channeled. And every institution that provides that service has the responsibility to best serve their clients' need as an intermediary. And that's why it's so important for every firm to really understand what is their purpose, what are they good at, how do they compete. And it's important for you, as you look around and interview with firms, to understand that and to know more about their culture and how they see their competitive edge and what they want to do in the world to provide this service to clients. So maybe now I move to Anna Maria. What would you add to that in terms of how the whole industry value chain works and where private equity sits?
Sorry, I was on mute. So where private equity sits, it's a part of the market, I think, for kind of relevance for you, if you're considering participants and considering going into the asset class. It sits on the mainly investment side. It goes all the way from venture capital to buyouts and special opportunities. So it's even if we talk about private equity on its own, it is so large that there's no way to describe it with one short brief description. So it goes from looking at startups that are trying to start new businesses, new products, to businesses that are already having some revenues, they're already making sales and trying to expand, to more larger companies that require money to grow, to also more of the tactical or trading strategy. So it's quite wide. I think nowadays where private equity is absolutely everywhere we are. We are sitting talking via Zoom. That is, it has had financing, private equity financing. If we look at, anything from Uber, all the kind of, services that you have now, everything's affected by private equity in some ways. So I don't know if that's what you kind of wanted me to cover, Natasha, but it's quite wide.
Yes, perhaps you can just elaborate a bit on the point you made earlier about the investments are made for significant time horizon, and that you strive to make it better during the process. Maybe you can just talk about that active role the private equity investors take in the company and the board.
Yeah, sure. So in a private equity investment, what we look to do is we spend a lot of time looking at a company that we like, or a sector that we like. There's various strategies where you can come in and either work with alongside management teams or take over a company and try to grow that business. Usually it takes 3 to 5 years. So it's quite a long time to actually get the investment to where you want it to be. So in terms of where it fits in the asset management, it's very long term, very, very long term. So 3 to 5 years for a company to kind of change the way it's been managed. And after that, what tends to happen is that either it's sold to another investor, it goes public, or it's sold to another private equity manager that invests in larger transactions. But it is very different in that I think there's some questions in the chat about, how should we prepare for a career in finance? And I think the way that probably Emma and Anna would prepare themselves is quite different than the way that I would prepare myself for private equity. So I am not looking at how the markets are doing every day. That is not what we look in private equity. I'm not reading. I'm reading the FT in general, but not to trade. And I'm looking at long-term trends. I want to see, if I want to buy a company now, I want to see where can I sell it in 5-10 years down the line. So I'm spending a lot more time looking at sectors, trends, and kind of macro big pictures as opposed to short-term investments and research.
That's great. Thank you very much, Anna. Anna Maria. Sorry, Anna, maybe now you can actually shift to the specialized equity perspective.
Sure. I just thought it might be helpful to start off with as well by saying, in contrast to what Anna Maria was talking about, the space that I'm investing in is listed equities. So these are companies where their shares are listed on a stock market, and you can buy and sell those shares every day. Now, I would say we still take a very long-term time horizon. So when we invest in a company, we are typically looking at a 5-year time horizon, possibly longer, when we want to own these companies. But if something were to change and we wanted to sell our position in that company tomorrow, we could do. We still have that option. So I think that that's an important difference to highlight. And then when you're looking at the equity space or the listed equity space, I would say you can sort of divide it into a few different buckets. So for example, you can invest in what we call just global equities. And so this may be a fund which invests in many different geographical regions, obviously across the globe and different sectors. You can also have funds which specialize in particular regions, so that may be US equities or European equities or emerging market equities. And then what I do is a subset of that, which is Asian equities. You can also look at different sizes of companies. So you can look at what we call large cap companies. So these tend to be more like the kinds of companies that you'll have heard of every day, and they have a larger valuation. So typically their market cap, so that the value of all their shares times by their share price would be more than, say, $10 billion. But you can also invest in what we call mid-sized companies or small-sized companies as well. And what might determine that decision is kind of your worldview, where you think, the US is going to be in 5 to 10 years time, or Europe, or you may prefer something that is more global in nature. And also maybe, people talk about different tolerances for risk. So sometimes, for example, emerging markets is considered to be more risky than maybe developed markets. And, that's something which you can debate, and it may even change over time. But just to kind of hone it in terms of what I do, it is incredibly niche, even within Asia. So the fund which I'm running focuses on what we call the demographic growth countries in Asia. And this is a really good example of kind of a worldview being expressed at a portfolio level. So of course, Asia is a very big place and it's very dynamic. But our view is that over the next 5 to 10 years, we're going to see tremendous growth in countries which have large populations and young populations and are going to benefit from what we call a demographic dividend. So these are countries like India, Vietnam, Indonesia, the Philippines. Actually, the fund that I'm looking at doesn't even invest in China. This is how niche it is. So if from a kind of client perspective, if they're looking at kind of what they think is really going to grow and develop and change over the next 5 to 10 years, then the product which I'm running is a really interesting option in that perspective. But it can also sit from a client's perspective alongside a more mainstream equity fund that has China or has the US or something similar. It's just a kind of an expression of a worldview, I guess. Natasha, if you'd like me to expand on any other kind of aspects of listed equities, let me know, but otherwise I'll leave it there.
Excellent. And actually, maybe we could tie this into just a very quick overview of the difference between passive and active investment in listed equities.
Yes, thank you. It's a fantastic question and very important point to understand. So there has been a big trend in recent years towards what we call passive investing. And this is typically when people or clients put money into a passive fund, and it's typically a lower fee. So we obviously all get paid in relation to kind of the fees which the clients pay. And then that fund will typically track the index. So if the US stock market, for example, goes up 5% in the year, and you have your money in a passive US fund, you should also expect to make 5% in that year. So you're basically tracking the market. So there's that aspect. And then what we do is called active management. So we're taking views and we're structuring our portfolios in a way which is different to the index, with the objective of actually doing better than the index. So if we were to take that same example of the US stock market going up by 5% in a year, if you have an active fund and you have a huge amount of your fund at the moment in, let's say, Facebook and Amazon and Tesla and all these companies which have done fantastically well this year, your fund could very easily be up 10, 15, 20% in 1 year. So a significant difference to the actual index. And then the difference there is as well, from a client perspective, you'll be paying higher fees. For me, it's really the active side of management that I'm particularly passionate about. But I think in the world of investment and people's different risk tolerances, passive investing, index investing does have a role to play.
Thanks very much, Anna. I would just add to that the role of analysts and portfolio managers is fairly different, depending on whether you're involved in an active or passive fund. As an analyst or portfolio manager in an active fund, you spend most of your time analyzing individual securities and spending most of your time understanding how to select just a small proportion of the stocks that are listed within your coverage area for the portfolio, given its objectives and your worldview. But you are mostly working directly with issuers, which are companies, and looking at their stocks or bonds in a very selective, filtered way. And then you also get very involved in exercising your vote as a shareholder during proxy voting. On the passive side, analysts and portfolio managers have a very different role because they need to focus on analyzing indices and benchmarks and sort of a much more composite view of what all these companies are doing, and thinking more in terms of factor characteristics. What's the volatility of this index? How can I make this index maybe even more effective and even cheaper than the tracker that it used to be? So there's a little bit more of a product engineering aspect to what BlackRock does, for example, and Amundi, versus to what Prusik is doing or Bailey Gifford is doing, or Capital and Fidelity. So just keep that in mind, as we probably will also discuss in a minute the difference between certain firms and being an analyst and portfolio managers. Now, Emma, over to you.
Yes, sure. So I can talk a little bit about just fixed income broadly, cover that, and credit more specifically. So, where Anna's talking about equity, when you're an equity investor, you're basically buying into growth, right? You want to buy into the concept that companies grow over time, sectors grow over time, and you want to own a share of that growth, right? Now, corporate bonds and just bonds more generally, the markets that I'm involved in, are a little bit different. What we're doing is we're loaning money to governments, emerging market corporates, investment grade corporates, et cetera, in the public market. And what we're getting paid is a coupon. So they're paying us a small fee over, every year, dependent on the risk of that company. And then they are going to pay us back, or the concept is they're hopefully going to pay us back what we lent them at the end of that maturity of that bond. So this goes across kind of whatever sort of subsector you're looking at within fixed income. And I think, so there's two ways you really make money as a fixed income investor. So one is just sort of that, what we call carry or coupon, that you get over a time period for when you've invested until when it matures, or until when you sell that asset. And the second way is capital appreciation. So we can't make money really on the growth of a company necessarily, but if a company over the time period when we own a bond, let's say they buy another company and suddenly their profitability looks really good, and the rating agencies who look at the quality of that company say, actually, this is a better company than it was when you bought it. Actually, we can see price appreciation in the securities we buy. So we can make money both through capital appreciation as well as the coupon or the yield we get. So I think that's an important way to frame how we think as fixed income investors. And I would just echo the comments others have said on the active versus passive. So Goldman Sachs Asset Management is an active manager. We are also tracking versus benchmarks. So when we have discussions with the clients, one of the first things we try to understand is, what are their needs? So what return objectives do they have? And then looking at that, sort of what risks are they willing to take? And that can really help us decide which sub asset classes within fixed income are right for them. For some of them, they have higher return targets. They might be more comfortable buying emerging market debt than, say, a pension fund, which really just wants to have sort of a steady income, not a lot of kind of capital or just price volatility, and we can work with them to construct portfolios. My day job, what it looks like, we have quite a portfolio manager trader hybrid role. So what we're focusing on, I saw a question here, so I'll try to address it as well, on the concept of how we position around risks in the market. That's something we think about all day long, so we're talking about the bottom up construction. We have a team of 40 fantastic research analysts whose jobs are to know the companies inside and out, right? They know basically everything about their balance sheets. They are the experts on that. And, as a trader PM and working with our credit PM, we're thinking about the top down of the portfolios. So what is our overall risk to certain things that are going on the market, say Brexit, right? We're constantly keeping an eye on how are we positioned versus the benchmark in UK assets? How do we feel about that positioning? And that's a really important part of risk management, is thinking about your aggregate exposures and really expressing the views you want, kind of by either being what we call overweight, so owning more than the benchmark, or being underweight, owning less than the benchmark. And those two things drive performance for our clients and for our portfolios, and it's something we're really focused on. Hopefully that answers the question.
This is great. Thank you so much. We have lots of questions that are coming through in the Q&A chat, which we're very, very pleased to see. And I'll start with the first one asked by Courageous Clara. Are opportunities for women equal to those of men in this industry? So Anna Marie, maybe first I'll go to you.
Sure, I think they are. I think it's an industry where there's a lot of opportunities for women. I think there's definitely an issue in that there's not that many women in senior level roles, unfortunately, still, but there's a lot that is being done to encourage women to choose careers in finance and to do well. I have felt in my career that I've been, as long as I did my job, I did well, and I continued to get promotions, and I got to partnership of my firm about 8 years ago. And so I do think there's opportunities. Do you need to work harder? I always get asked the question, and I don't think it's the working harder, but it's actually other things that have helped me as a woman, which is networking is very important. And I felt that as a female, I sometimes had more EQ in some ways, in a lot of situations whereby you need to have the empathy. And I think there's a question about empathy. Do you think that's helped? I definitely think that has helped in my career. And that is something that we should all be, very proud of, the fact that we are who we are. That we're not going to change, but this is a career that should be very good for women.
Anna or Emma, would you like to jump in to add something?
I was just going to try and share some positive messages on this front. So when I did the internship, it was quite a long time ago now, back in 2005, there were 7 of us doing the internship, and the 2 people who were offered jobs were the 2 women out of that 7. And both of us are working as fund managers in the industry now, whereas what's happened to the remaining 5 is a bit mixed. I would also say that the founder of the company that I'm working for now is a woman. And I actually work in a team which is predominantly women as well, which is we're 60% female in our investment team, which is extremely unusual for the industry. So I just wanted to kind of share some of these points just to kind of, highlight that there really are some positive stories out there for women in this industry. And I actually think from here, longer term, everything that we've all been going through this year could be very interesting for the role of women in the investment industry. If we do move towards working from home becoming the norm, say 3 days a week, that is actually going to make things much easier when it, in terms of childcare and taking that step when that happens. So I think it's a fantastic time to be looking at the industry.
Emma?
Yeah, I mean, I would completely agree. I think, I think the big banks like mine and even smaller funds, et cetera, are really making a push to make sure that their talent pipeline is as diverse as possible on every metric, right? Diversity of thought, gender, race, et cetera. And I think that we've all kind of come to this agreement that actually diverse funds outperform and, diverse teams outperform. I personally believe it's the case. I've seen in an environment how having diverse opinions leads to better outcomes. So I think that the focus from the investment management community is on that fact. And I hope that that's where most are aligned with. I would say, I think in my firm, unfortunately, or at least in my area, there's not a ton of senior leaders that are women that I can look up to. And I think that that's something that as that changes over time, it will be easier for the people coming up in the pipeline because, you want to envision yourself in a role and see someone that you're aiming for in terms of role model. They don't have to be the same gender, but I think it's helpful sometimes to see that. So I've always just tried to, think about my peers around me who I'm motivated by, people who are maybe one step ahead of me, and kind of focus on the career they've had, use them as a sounding board, find sponsorship and friends amongst your colleagues and people going through the same things as you. And I think I've found it personally, an amazing opportunity. And I think that we've got a ways to go at senior levels, but I think we're making the right steps when we're thinking about, the hiring process now.
Thank you. I will just add a couple of my thoughts on why I switched careers, why I went from investment banking to investment management. And that is because I felt this is a career where what you do is measurable. And when it's measured, it's far more transparent. So I felt like, although it's never going to be an easy linear path for women in finance, I felt like this had just something more of a meritocracy built in, because you are measured against the market or whatever objectives are set, sort of by the market. And that made me feel much more confident than in investment banking or, consulting, which I did during my internship between first and second year of HBS, where I felt like it's so transactional and it's so driven by just the ever-changing needs of clients that I'll never know if I'm doing well or not. So that's one area where I think it's important to focus on what makes you feel confident and resilient to succeed. And that was a big factor for me. The second one is that your expertise in investment management is cumulative. So the more you work, the longer you work, the older you get, the better you are. And I mean better in terms of how much expertise you have to contribute to a project. You may not pick the best stock of the year, but with time, you're really valued for your observations, insights, experiences from other areas. And that's a really gratifying feeling. And again, I think that's something women are very, very good at. For me, becoming a partner 10 years ago, 11 years ago, was challenging because I had such young kids. And I didn't want to switch what I was doing. I had just become sort of a fully fledged, fully sort of robust analyst, really in my pace, and looking forward to becoming a portfolio manager. And actually, my husband decided to scale down his ambitions. And he had already been a managing director. He was a trader as well. He thought that for him, mechanically, it's going to be easier to scale down than for me. And 11 years ago, there were not a lot of dads showing up to school. It took me a while to convince the school to stop calling me, that they need to call Monsieur Mounier, and that he's just as good at getting the kids to the doctor as I am. And it actually was very, very fulfilling for him, because everyone treated him like a gold star hero. And I think actually it was a very rewarding experience for my sons and for my husband. Now, when I go to the school, now as a volunteer, because I continue to be involved with them, I see a lot more dads showing up. And I see a lot more dads in our neighborhood, with strollers and little children. So I think the equal opportunity for women in success career-wise comes from the fact that there's an equal opportunity for their partners to succeed in parenting. And I'm not sure that was really available to them before. So this is a very, I think, important pivot in society of how we approach those responsibilities, and that we can both thrive doing different things. So we had some other really interesting questions. We had questions about how do you source information, and how do you prepare for thinking about investing, and interviews that might ask you about investment ideas. Maybe we can just go around the panel and get some insights for that. Anna Maria, do you want to start again?
Sure. In terms of what to look for,
informed and getting ideas.
Yeah, getting informed. There's just so much. I think at the moment it's more of there's just too much out there per se. So it depends on what I would look at, and what Anna would look at, and Emma would look at is completely different. But I do listen to podcasts a lot. There's some fantastic managers. I cover a lot of technology. So if you look at Silicon Valley people, there's one in particular, Andreessen Horowitz, that is one of my favorites. He's great in terms of how he positions what he's trying to do in themes. So that's one to look at for tech. Otherwise, I would say just read as much as possible. There's a lot of universities research about sectors and trends in the future. So that's also quite important to look at it for a long-term basis. But I would imagine Anna and Emma would probably have other thoughts in terms of what's more up to date in terms of decision making on a more kind of shorter time frame as well, and more specific in your regions, Anna and Emma.
So I think if you're thinking about the question from the perspective of preparing for interviews, one thing I would really recommend is that you pick either one theme or a couple of themes, or one company or a couple of companies that is already kind of interest to you. So say, for example, you're interested in the development of electric vehicles or AI, or you think sort of Facebook is a terrible company, and you want to sort of understand that better from a kind of investment perspective, I would start to kind of track a few companies or a few themes over time. And as Anna Maria touched on, there are so many resources available now to everyone to do this. So you can look at case studies on YouTube. You can go to the company website and just get basic information from just the simple text that's there, but there will also be an investor relations section on a company website where there'll be presentations and an annual report if you want to dig in more detail. Of course, you can just follow these themes and companies in the news. And I think just by kind of following companies or themes over time, you'll see how things can change, and that might change your own perspective on these companies or themes, or it might not. You might have a view to start with, and everything that you come across either confirms that, or you don't think some of that news is too important. And actually that process in itself is somewhat akin to the process of investment in some ways anyway. And actually, if you can kind of demonstrate that kind of process and thinking in an interview, I think that would be a really good starting point.
That's excellent advice, Anna. Thank you. Emma?
Yeah, I would definitely just echo that. I mean, an example from when I was interviewing, as I said, I did not come in from a finance background. So the whole process of the interviews were quite daunting from that time frame. And I think the way I approached it was similar, which was I just written a paper on fracking for my environmental science class. And I was like, fracking, okay, there's a topic in there in investment, right? There's loads in the news about this from a company perspective, looking at it from every angle. So I really dug into that concept. And I was able to go into my first interview of the day at Goldman, talk for 15 minutes about fracking. And I still talked to the guy today who interviewed me and said, you sounded like an analyst. And I think all people want to do when they hear, someone in uni is hear how you think about things, right? Be analytical, show you've been thorough. Those are the things people are looking for. They're not looking for you to, know everything about markets or how even stocks and bonds work. We just want to know that you know how to think and you know how to structure ideas and arguments. And I think if you take that approach, almost anything you get asked, you can steer towards your interest, right? If someone says, what's your favorite color? You can say blue, or you can say blue because I play soccer and, our color was blue. And that's your, I'm the team captain, so just thinking about ways to answer questions to get to what you want to talk about so you can show your expertise. And then I think the second thing I would say on that is, it seems like an easy question and you might have heard this, but really practice the about you, right? This is one of those places where you think it's easy to talk about yourself and it's really not, because you can, you've had a very long life up to this point and you can go in and narrate the entire life and really not, walk away from that experience feeling like you've left them with something, that's really impactful about what you're going to bring to this role. So I would say I practice that probably 200 times. I am not kidding you. I tested on everybody. I got feedback. I really got to a punchy story about why I was sitting in front of them on that day, looking for a career at Goldman in investment management or Morgan Stanley or wherever I was interviewing. I got to a point where I really was comfortable and I could do that like the back of my hand. And I really felt like it was concise and to the point. And so I think if you nail those two things, like you'll really stand out as a candidate in almost any process.
This is great. Emma, the fact that you went through 27 interviews in 2 days is a testament to the fact that you can never over prepare.
I bombed some of those for the record. I want to just tell you guys, you can still get a job. I mean, they put me in all these interviews with acronyms and I didn't know what any of the acronyms were, right? I was in front of someone and it was like a hedge fund solution group. I didn't know what a hedge fund was and I had to ask them, and someone asked me like some math question about like which is the quickest way for a spider to get across the room. I asked if it could spin a web. They were like, no. So, you don't have to know them all to get a job. Some failures are good for resilience, and every interviewer is different, right? We're all people when we're sitting across the table from you, and hopefully an interviewer is trying to get the best out of you. Not every person will do that. I personally take the approach, I want to see you at your best, right? Like we're not trying to trip you up, but if you have a bad experience, move on. It's a two-way interview and use that as an experience to learn about the company and if it's a place you'd want to work.
This is great, but it does sound somewhat terrifying, but thank you. Sorry, yes, Anna Maria.
Sorry if I may add to what Emma said as well in terms of interviews, I think one of the biggest things that I've kind of like when people come to interview with me is that they've actually have interest in the company and they have done the research. And now we've got, LinkedIn is packed with information that we have every day. And if somebody tells me, well, I've read this that you've said, or I've read about this company that you invested in, and I'm very interested in that. So it's not about the grades. Obviously, you need good grades, of course, but it's actually about, are you interested in this, and can you understand what we're trying to do, and did you actually spend time looking at what we do and understanding the people that you're interviewing with? And one final point, I did think of another one that another kind of research location that I look at often. It's Howard Marks' Oaktree. He does memos, and they're amazing, and they actually are like, just proper memos, which doesn't have much jargon, and it's really interesting. So if any of you want to get his thoughts on the markets, it's a good place to go, and I think they're on their website.
Yes, very good points. I will maybe close this question by adding a few observations of my own. I believe that it's really important to read the FT every day, or the Wall Street Journal, or whatever it is that you consider your go-to financial newspaper, because it does a couple of things. Not only it keeps you informed, but it teaches you the language of the business. And it will naturally also help you to understand what gets your attention, like what gets your pulse up, what gets you excited, and what makes you frightened and scared, because that'll be an important piece of your knowledge about what is your risk barometer. This is a really important attribute of successful investors and people who are interested in the career investing, is to know sort of what is your own risk appetite and where your interests lie. So I think you have to be disciplined and really make that time every day. And I think the FT is free for universities anyway. So, between that and The Economist, you can get a good dose of understanding of what's happening around the world in markets and companies. And next step from that would be to have your paper portfolio. Pick 5 or 6 stocks. It doesn't have to be a large number, and load them up into your, Google Finance or Yahoo Finance, whatever paper portfolio, and start tracking them. Meaning, you go to the website, you read the investor presentation, you look at the videos of the CEO, you look at their governance and board structure, and you start to really build a narrative about why did you put this company in the portfolio. I had my kids do this when they were adolescents, and it was actually really fun, to hear their unfiltered views of why they thought a company might succeed. It was obviously very brand related. Now, that they're older, they will have more sophisticated views, but I feel like it also creates a much deeper understanding of what makes you tick and what you think makes companies succeed, so that when you go to interview, you'll have a much richer conversation about your successes and your mistakes. So the last thing I would say is that investing requires you to accept the fact that you will make mistakes, and you will make them often. So the idea is that you make mistakes less often than you make good investment decisions. But you have to have the humility and the self-confidence and the resilience to know that this will happen. And that's why I think reading about mistakes and then making them in a paper portfolio will give you a lot of insights and ammunition to deal with it in real life. And even the luminaries like Howard Marks or Ray Dalio, who I read also on LinkedIn, he publishes all his memos, or Warren Buffett, who I absolutely think you should read, they've all made mistakes too. So it's really enriching to understand their perspectives and where the mistakes have come from. So we'll move on to the next question. There was a question from Timmy to Anna about emerging markets and how do you invest in something so volatile and unpredictable? And there was a general question that we can also wrap it up for the whole group is, well, how do you beat the market? So maybe we start with Anna in China and then move to everyone about how to construct a portfolio that beats the market.
Okay, so in terms of investing in emerging markets and this idea that volatility might be something that would put you off. One thing that I would really like to say is that traditionally people are often taught that volatility is a form of risk. But actually the way I would see things is that the key risk that you're up against when you're investing is permanent loss of capital. So if you invest in a stock and it's going up and down like this, you can say it's volatile. But if you're buying it here and ultimately selling it right up there. It really doesn't matter how volatile it's been in the interim. So I really think, and actually what's been very interesting for me is kind of starting off my career by working for 1 year on different geographical teams and seeing how actually the investment approach that you apply in one geography is actually very similar to what you would apply in all the geographies. You know, for me, I'm a growth investor, and so really what you're looking for is a large addressable market that's growing rapidly with structural drivers. You're looking for a company with a very strong competitive position, and a high quality, thoughtful, you know, long-term minded management team that you can really, really trust. And if you have those three things in place, actually, you'll often find that your investments will turn out very well, whether or not you're investing in Europe, the US, or emerging markets. And you know, I would highlight there's a company, you know, if people are looking for a company to put into their paper portfolios at the moment, I'd really highlight a company called SEA Limited, that's SEA Limited. This is a sort of an emerging company in many ways, but a really fantastic story to follow. It's a combination of e-commerce and gaming in sort of South and Southeast Asia. And that really, for me, exemplifies this idea. You know, when we first invested, it actually lost 35% within the first year, but that's a paper loss. Since that initial investment, our money invested in that company has now risen 12 times. So a 12-fold investment. So you can think about emerging markets as volatile, or you can think about them as a fantastic growth opportunity, which is absolutely what I would do. Sorry, I forgot the other part of the question.
How do you beat the market?
Oh, beating the market, yeah, I mean, probably everything I've just said above, it would answer that same question. So we would kind of follow a bottom-up approach where you're really trying to invest in the best companies. And rather than kind of taking big picture macro views, you know, if you are in the best companies, whether or not the world is doing particularly well or doing particularly badly, these better quality companies are generally better placed to manage those ups and downs. So that's something I would really encourage everyone to think about. But yeah, I'm quite conscious of time, so I'll stop there.
Thank you very much. Emma, do you want to jump in?
Yeah, sure. So I'd echo those comments and just say, I think, you know, in the fixed income markets where, at least in credit, you know, things we're thinking about is how to size positions. And that's really dependent on your conviction, right? So if the benchmark owns 1%, but you think this company is going to outperform, you know, say it's like a deleveraging story like Anheuser-Busch and InBev, or among others, you can own more than the benchmarks. The first I'd say is size, which is really dependent on conviction. The next is the composition and construction. That's both bottom up and top down. We really think about, you know, in fixed income markets, the things we're thinking about are what our curve positioning is. So, you know, do we own more of the middle of the curve, more long bonds, more front end bonds? We're thinking about that. That can really drive performance. Another thing we think about is currency. So I invest in euros, sterling, dollars, occasionally CAD, usually not CAD. And we're really thinking about which currency, which bonds in which currency we think are going to outperform. So we're thinking about all of these different things that's coming together. And like I said, having an amazing analyst team with the depth of knowledge to really provide the bottom-up investment and avoid the landmines, ESG related or not, just really thinking about avoiding those kind of the treacherous places in the market where things can go really wrong.
Thank you. Anna Maria.
In addition to everything that Emma and Anna have said in private equity, there's the added complication, which is access. We cannot buy companies in the market, so you have to be able to find the company and make sure that company wants to take your money, or you're able to buy it. So access, very important. Network is very important. Incentivizing management teams to have this ambition that you have is very important. And obviously it's knowing when to buy at what price and what to sell. That's really key.
Thank you very much. Well, from where I sit and where my interest lies is to highlight the importance of being an actively engaged shareholder. I think that leads to much better outcomes, no matter what you're investing in, you know, whether it's fixed income or equity. when we talk about ESG and sustainability, what I think we're really talking about is having a very long-term horizon on outcomes and thinking about outcomes that go beyond just near-term financial gain. And this is what should help everyone make better investment decisions and over time improve the quality of the market itself, sort of the beta, but also help us deliver the alpha. So we are on the hour. Thank you so much, everyone, for joining. And thank you very much for the wonderful panelists. I really enjoyed this virtual discussion. I hope to meet you in person soon. So Anna and Emma and Anna Maria, thank you very, very much on behalf of GAIN. And thanks, Sophie, for setting everything up for us. If there are other questions, we should follow up by email and look for us on LinkedIn. Thank you and have a wonderful evening.
Thank you, everyone.